in 1987, it was this portfolio insurance, which is not in computer program trading. And I was actually an intern at a brokerage firm back then, which way back when, it tells you how old I am. Actually, I was very young then, so I'm still young. But this program selling could be very similar to the CTAs or the vol selling firms getting liquidated. I mean, Volmageddon was, we had a 10% drop within like 4 days in that February of 18, I think, 17 or 18. And yeah, that was rather hairy, but it was fairly contained. Now it's like 50 times bigger.
Welcome to the Rose Show podcast. Welcome to the Rose Show. I'm Rosanna Prestia, your host, and I'm here today with Tom Thornton. He is the founder of hedge fund Telemetry. He's also a portfolio manager of his own hedge fund. He writes an amazing daily market note on macro and markets. He's also a former senior trader and technical analyst, and he's been doing this a long time, and we love his macro and market analysis. How are you doing today, Tom?
I'm doing very well. Thanks for having me back on.
Thank you so much. It's your second time, and it's actually been a year since we last met. Last April, we had you on the show, and then we met in person at Brian Shannon's book event in Manhattan. So grateful to have you back. Always love your take on the markets. So, what is going on with this current market? We had a strong bull run. We were running up since October bottom in November. And now the past month, the indexes, S&P has been about the same, I guess, a rotation going on. What are you making of all this?
Well, I'll be honest, it's a little perplexing, and it's not the market I like to trade, to be quite honest. I like markets that have a little bit of volatility and pullbacks to enable you to buy dips. And dips today seem like they're 1%, and it's a generational buying opportunity for people. And I think that's partly due to a lot of fund managers that have underperformed. They are scrambling to buy everything they possibly can to try and make up against their benchmark, which perhaps is the S&P. And it's very, very difficult for a fund manager to outperform the S&P when it's very narrow. And when I say it's narrow, it's because you have NVIDIA that's attributed to about 35 to 40%, give or take. It's up a lot today, so probably closer to 40% of the market's move. And that's more than double of the next attribute. And it's challenging because you can't put that much into one particular item, one item or one idea. So you have limits. And the funny thing is we go back to market pullbacks. I tend to be a little different from what you might see on CNBC or some of the other channels, because they come on and they talk about what's working, and they'll talk about NVIDIA today and it's up dramatically. I am the type that I'm looking for ideas to plant in the ground and then have some green shoots come out. And for example, last December, I had crickets when I said I am overweighting my portfolio, and I had about 20% of my portfolio starting to invest in energy stocks. And that was just again, crickets. Nobody cared. There's no AI in energy, and there's no reason to be in there. And I added more in January, and lo and behold, the energy sector, XLE, has been the best performing sector in 2024, which is not really getting noticed. I actually last week started to take the exposure down dramatically. I think I have around 6% energy left with gains, and some of those gains averaged, around 20%. And so I was really pleased with that. On the other hand, I'm short stuff, and a lot of shorts have not panned out. It's difficult to short a market like this, but you can find ideas that get overcrowded and let's say have technical exhaustion signals or overbought areas, and they fall back down to earth. I did that recently with Costco, quick hits and things like that. Ulta Beauty was one as well. But it's really been difficult, and tech is a very difficult place to try and look for shorts, and that's the challenge of this market right now. And I think that people are getting a little too complacent in the market, and we're starting to see some cracks with market sentiment cooling off a little bit in the last week. There's been a range in 2024 with market sentiment that has been the pullback levels, and they buy them. And they broke that last week with the big bearish engulfing day. And I think that there's some technical damage that's starting to happen. Today is a day where everything's getting squeezed higher and the techs are you know, buoyant, and you had a PPI number that was a little cooler. That this market, the participants absolutely love anything that could be possibly dovish where the Fed will cut rates. And I've been in the strong belief that the data-dependent Fed, they want to cut rates, but they're not getting the data that they need to justify cutting rates. And I think that is something very important. And even if so, that's been the Fed has been saying, oh, we're going to see inflation gradually go down. Powell, I should say, where it's going to go to our 2% target rate. And the last mile is always the hardest to get prices to come down in a uniform way. But that hasn't happened, and you've actually had, as I mentioned, energy has done well. Gasoline prices on average dropped 21% from September to January, and now they're up around 17% from that January low, which is starting to contribute to the CPI data. And that is a problem because that's been one of the big beneficiaries in the lower CPI data. So I think that right now the Fed is in a difficult spot because they, again, want to cut rates, but they're not getting the data that justifies it. And I think that anytime you get some sort of, positive mention on inflation or some data point, the market just runs, rampant on the upside. Remember one thing about inflation, and you see it with a lot of economists and politicians especially. Oh, inflation is down. Well, that's great. That means that prices are going up slower than they were a year ago, and they're still going up. And I think that everybody watching this can attest that they're not seeing prices at the restaurants that they go to, or at the gas pump, or car insurance. I just had to redo my car insurance, and I felt violated from the prices. Everything seems to still be high, and it's not down. And you still have prices in many places within the data up 20% in the last 3 years or more. And that's not coming down. We need deflation to happen, and that certainly is not happening. So I think that economists and the Fed can cheer the slower inflation numbers, but it's still sticky and still expensive, and that's going to wear on the consumer. And I don't know when we're going to see the consumer start to break. And certainly there's some magnet with the market going higher that's going to keep spending okay and unemployment lower. And maybe that's the no landing scenario. I don't know. I don't know. So I'm cautious in the markets. I always am. And it takes a high bar for me to buy something. Again, energy was a really good opportunity. I have another idea, but we can talk about that in a few.
Exciting. Thank you for that overview. And we'll definitely get into those great ideas you have. Tom, excellent call on energy. I have to say, when things look grim and when they seem so oversold as opportunities, and you pounced on that, and wow, I mean, I guess no one was really thinking or talking about that at the time, and great call. So excited to know more about those calls. You nailed it right. Inflation is cumulative. And just because it's increasing by a lower amount doesn't mean it's not still increasing. It's just like gaining weight. If I gain weight like 5 pounds last year, but 2 pounds this year, I'm still gaining weight. So
You look
very
great, by the
concerned.
way.
Oh, thank you. Well, I hope I'm not gaining weight, but just giving that example. But we're still increasing our inflation and prices are not coming down. And the compound aggregate inflation since 2020, like you said, it's in the 20s and 20%. And it's the money supply increased significantly. And this will take a long time to work its way through the economy. And there's liquidity injections from the Treasury. And we see massive spending to no end, massive public debt increasing over 34 trillion. To me, I start to think maybe the incentive for the Fed to cut rates is really to reduce that interest expense on that massive debt. I see no reason, just like you, to cut rates. We have on paper a strong jobs market, even though there's a rise in the gig economy and part-time jobs, inflation's trickling back up. And we have public debt that's public, fiscal spending that's bloating GDP, and disguising the hardship of the private sector. And like you said, prices are elevated and we seem to get ripped off everywhere we go for car services and all kinds of things, and the price of eggs and everything, of food. So very concerning. And when will it hit the consumer that it affects these stocks? And you talk about NVIDIA being the leader, and it's has a great moat. I think it's a fantastic AI company, and but who are its customers? And at some point, will those customers have to reduce because they're affected by what's going on in the economy? There's so many questions, like you said, to explore. We just don't know, and we have to remain cautious.
Yeah. Well, one thing, I lived through the dot-com bubble and made it through, and I worked for a hedge fund in 2000, and it was really pretty interesting. And there's some parallels with the AI craze and the dot-com bubble that happened. And I first of all, I think that well, I'll start this way. You have the companies like NVIDIA and others, AMD, Dell, some others that are the picks and shovels, like the Cisco's out there and Intels and others that built the internet economy back then, the dot-com economy. And then you have the customers. Back then, there were the telecom companies, the Bells, the AT&Ts, the phone companies that were buying all the switches and routers and everything to build out the internet. And then they were tripping over themselves to double ordering everything they possibly could to get allocations for that product. And then all of a sudden, they started to say, you know what? We're kind of hitting the end of our CapEx level here, and we're not going to be spending as much in the next year. That sent a shudder into some of those names that were supposed to grow forever and slowed, and that was it. And that's when Cisco peaked and Nortel, which was a Cisco competitor that's no longer in business. It used to be the largest Canadian company, but it's no longer. It's that was the Northern Telecom. It was the biggest. It was like AT&T in Canada. But those companies pulled back on their spending because they had enough internet stuff to move forward, and they kept spending, but slower. And that's probably what's going to happen with NVIDIA and some of these others, that they're going to get their data centers, and the companies that are buying aggressively, Meta, Amazon, Microsoft, just a bunch of others out there that are building these data centers or upgrading their data centers. They're going to get allocations for all the AI stuff that they need. But here's the thing that is kind of interesting that I want to know, and I don't know, but what companies are going to be the beneficiaries of AI down the road? What companies are going to be, because the picks and shovel companies, they're going to hit a limit and they're going to say, okay, that's enough. But will those companies, the Microsofts, AWS, Amazon and Meta, Are they going to see the dramatic upturn in earnings to justify where their stocks are today? I don't know. And there's going to be new companies that are going to come on that are going to be, you know, creating AI models that are profitable. And that's going to take time. And that's what really came out of the dot-com bubble, is everything blew up and went to ashes. And then all of a sudden, Priceline, which was, sky high, came down and then started to show a way to monetize the dot-com stuff. Amazon as well. Amazon went up 6,300% in 19 from their IPO to 1999 or 2000 and went down 94%. So as much as the people say, oh, if you bought Amazon at the IPO, yeah, you'd run it up and then you'd lose 94%, which would be a very difficult thing for any fund manager that would still be in business. But that's the problem that I see happening. And you have, a lot of people said, well, Cisco and, NVIDIA are different because of, the valuation is not, absurd. And okay, that's fine. But the market cap move in NVIDIA is absurd. And that's the thing that I think will probably catch people. I don't know when, but eventually it will catch people because you're talking $2.5 billion each point in Nvidia, and it's up uh, almost 30 points today. And that's a $75 billion move today in just one day in one company. And their revenue guidance for the full year in this year is around 100 billion. So they're three-quarters of their revenue guidance this year is in an increase in market cap today alone. It's just that's where you could have a problem where people get so crowded into these names. And look, if you made money in it and you're making money in it, don't forget to monetize some of it along the way. I've traded it. I've traded on the short side. It just recently went down around 13%. I had a short that did okay, but I don't want to really hold it because I'm afraid they're going to do a 2 for or a 4-for-1 split. And if they do a 4-for-1 split, to think that, retail thinks that, oh, well, it's back to last year's prices, but it's not because the valuation is not. And it would be $10 billion each point in market cap move, which is just nuts to think about. So I think that there's a bit of irrationality with a lot of these names out here. And again, going back to the concentration, if you're not in these, you've underperformed, and what happens is people jam into them too late, and then things like what happened to Cisco happen, and they come down. And I could tell you back in the dot-com bubble days, I remember that there was a company, JDS Uniphase, and this was a optical networking company, and it went up just absurd numbers, and it came down. And I remember, like, I had an electrician because I was building a house at the time, and he's like, hey, Tom, when should I buy more JDS Uniphase? I bought it high. And I'm like, hey, you don't want to buy anymore. You probably should sell it. He's all right, I don't want to take a loss. And if he did, he probably would have saved a lot of money because it continued to go down. And it eventually went from, like, I'm just going to throw it out, like $200 down to like 10. And that kind of stuff happens. And I just think that people don't recognize that type of risk that's happening in the markets today. One other thing that I just want to mention, why I think the market is just, the equity markets are in this sort of bubble territory, and it's why it's been so difficult for me. And I'm like humble as can be. I've been wrong. I have not had a great year, partly because I like choppy markets. But the bond market has been selling off from February, and the equity markets have just ignored higher rates. And you have the 2-year at 495, the 10-year at 456. I mean, maybe that doesn't matter to the bond market, but it actually should, because it's harder to borrow money. It costs more money. You brought up fiscal. I, there was I forgot, I think Bank of America's Michael Hartnett said that he just pointed it out, saying that the US uh, debt goes up $1 trillion every 100 days. $1 trillion every 100 days. So that's, $3.5 trillion every year that it keeps going up. And again, the government just keeps spending like there's no tomorrow. And for politicians, there is no tomorrow because they just need to get elected, and giving their constituents the goodies and spending like, oh, it's great. Look at the market's higher. It's all good. But it's going to come down to a point where that's going to weigh on the economy and the markets. And I'm not really political. I'm very actually anti-political right now because I don't like either candidate, and I'm a none of the above type. I'd be happy if someone was a bit more center and younger and had some policies that made sense because of all this spending and all the craziness that's gone on. But we don't have that. So I think whoever wins next year, the bill's going to come due, and that's probably when the economy has a problem. And I don't think the Fed's going to be able to save the day. And if you go back in history and you look at Fed cuts cycles, Fed cut cycles, most people remember 2020 when the Fed started cutting rates and they did QE like crazy and the markets went up. That was sort of a different scenario because of the pandemic and the amount of stimulus that they did. But when they usually cut rates, it takes a cycle, and it always is the last one that does the trick because the markets tend to sell off because the Fed knows there's a problem with the economy. Maybe it's unemployment starting to go up. And when unemployment starts to go up, it doesn't necessarily stop in a quarter or two. It goes for over a year. So that's a problem that people just don't remember, or maybe they just are ignoring the issues that possibly could awake in the future. So I think that this Chuck Prince of Citigroup back then said before the great financial crisis, the music's playing, so let's keep dancing. And they kept dancing until the music stopped. And if you go back and you look at Citibank, and it's a reverse split, and they report tomorrow, $60. So it was a 10 for 1. So it would be like $600 was their high, or what it would be. But it's six. So they're so far off of their old highs, and they're probably never going to go to those old highs. So it's just, there's risk out there, people, and it's in front of you. And I think that people need to keep a cautious approach when they look at the whole macro, when they look at bonds and they look at commodities are starting to go higher again. There is risk, and it can happen pretty fast. And maybe during our podcast here, things will happen. Just
Right?
kidding.
No, Tom,
I have a
you
sense of humor, people.
I love it. No, it's great. Your words of wisdom, I have to say, from your experience, and you bring a real intellectual sense to this and the logical side. And you're right. I mean, it's that music just keeps playing, and it's detached. It's like the equities market's detached from reality, and it definitely goes on. It can go on much longer than it makes sense. And, great analogy to 2000. I think it's important everyone study their history. They seem to be caught up with recency bias, and 2020 is not a good example to look at. It was a real anomaly, what went on with COVID. Like you said, markets move much lower once the rate cuts begin, once the cycle begins. And it's definitely something to be cautious about. But are you short-term bullish? We remember back to dot.com with the stocks back then, and it went on much longer than anyone could imagine. Do you think Nvidia is probably going to go on much longer, and the other AI plays until it just can't, maybe later this year?
You know, I'm comfortable saying I don't know, and I'm comfortable not being in those. That's as simple as it gets. I just, you know, I have a process. I try to stick to that process. Trying to buy high and sell higher uh, after some extraordinary moves. I remember back in the dot-com bubble that a lot of people tried to do that, and it worked for many people. And you can be a short-term trader and do exceptionally well. But again, it doesn't take much to see something pop. And you know, you can look at super micro, and that fell off really hard. And you know, that look, I don't know, but it's just you have this crowding in these stocks. And you know, super micro is kind of crazy because it's contributed with micro strategy about 40% of the whole Russell 2000 gain. And if you go and you look at the breadth of the market for the year to date, you have more stocks in the Russell 2000 down on the year. And if you didn't have those two, the Russell 2000 would be down on the year. And the Russell doesn't like higher rates. Small cap companies and mid cap companies, and they don't like higher rates. You know, some of these mega cap names don't care about the higher rates, and people understand that. You know, the Fed's been sort of ineffective as far as tightening the market and financial conditions. And that has implications which are not today, but down the road are gonna wake. And you know, I hate to be this like bummer, um, you know, like, oh my God, this guy, I can't even believe I'm listening to this guy. But I do like a few places, and I should probably mention, and you'll probably have people say, oh yeah, he's crazy. But I like China technology and Alibaba and Baidu, and I'm long KWeb, FXI. Those are the ones that I'm long, and nobody likes China. And I was you know, let's go back years. I was an early buyer of Alibaba pre-IPO. I had this opportunity to get in some IPO pre-IPO shares through a friend and a friend, and it worked out great. And Alibaba was a huge winner, but the government in China saw the power that these CEOs had and the billions that they had and the amount of money that they were, you know, moving around in China, and they clamped down. And that happened, and it's been several years where these stocks have been absolutely killed. But China's starting to change a little bit. And China's actually had deflation. They've had prices go down. So they've just had some recent Chinese economic, I'm losing my voice, economic reports that showed inflation. And that's actually what they want right now. And that's saying that their 5% GDP could actually happen. And that would be an uptick for them. And China's a humongous country with, you know, many more people than the US, and that number's a big number. But I think that Alibaba and Baidu are two companies. If you want to go into AI, those are companies. Alibaba trades at 8 times earnings. Baidu trades at 10 times earnings, and they both have boatloads of cash. Alibaba bought $4.8 billion worth of stock in the last quarter. That's up from 2.6 billion the previous quarter. So they're buying back a lot of stock each day. They brought back some older management, Joe Tsai, who owns the Brooklyn Nets and a couple other teams. I forgot if it's a football team or baseball. Anyway, they're really smart, and they're the ones that are turning around Alibaba. They're streamlining the company. There's been just a bazillion amount of subsidiaries within Alibaba, and the government is actually a bit more supportive now. And they just had the vice premier at Baidu, and they were talking up AI. And Baidu they have so much cash. I think half their market cap is in cash. And if they have a Baidu AI conference next week, and that it trades at 10 times earnings. And if you have a turn a little bit in the multiple, I think that these can really work. So again, nobody likes China. There's not a lot of money that's allocated towards China, much like how people didn't have money allocated towards energy back,
Mhm.
5 months ago. And now you have strategists are saying we're overweight energy. It's better late than never, I guess. But the point is that it's going to take a little time, but when these start to get moving, you're going to have a lot of capital look at them and move back towards these stocks. And it's got a technology component, it's got a consumer component, it's got like an AWS cloud component. And look, they're beating each other up on pricing right now with cloud, but I think that's sort of the natural thing that happens near lows. So I like these. They're starting to work for me, but I think there's a lot more ahead. And let's see.
Exciting. Those were all Baidu and Baba were both my former trades. I've traded them before many times. I love their value. So you nailed it right with the low PE as well as high cash stacks that they're sitting on over there. Many people talk about the geopolitical risk, obviously, with China. But yes, they're cash heavy companies that seem to have it all and very good value as well. And, Tom, I love your strategy. I have to say, there's many people, they're trend followers, they're people who buy breakouts. I'm not one of those who buys breakouts. I like to buy value as well. But, I love that how you use your indicators with overbought and, oversold, and you look for opportunities like you did with energy and with China, the ones that have that value and are just unloved at the time. So I like that. It's like a contrarian view.
Yeah,
Um,
I'm a contrarian,
right?
definitely. Yeah, and listen, I I would have, it's funny. I was long at the lows in 2022 was a really good year because you had a lot of choppiness and there were a lot of
Mhm.
buy the dip opportunities and sell the rip opportunities. Uh, and then at the beginning of 2023, I did buy Nvidia and I bought it at like 120 and I sold it at like 140 and I thought I'm a hero,
Great
great,
trade.
nice trade. Like I don't look back though. I don't, look back and say, "Oh, look what I could have had." That's not thinking that helps anybody move forward. Hindsight is not something that I employ in my brain. I'm far from it. Every day is also something that traders need to remember. You have data that you have right in front of you today, and you have to sometimes react to that data today. And that is what a trader does. And so you're as good as you can be on a day-to-day basis with that in mind. Um, so, you can think, oh, I like this valuation in China. I like these are going to do well. But you do have to manage risk, and it's not necessarily easy because they're not going up and they're not as favored. And when they do move into that matrix of momentum, then you can kind of ride them. And I did that with energy, and that worked out. And I still like energy. I just want to buy. I have a little, but I want to buy it on the dip. I want to buy some with a pullback.
Well, commodities have also been running hard, the silver and gold miners and copper. And many are saying it's overbought. And then others are saying it's going to go much higher. And we're in this, secular inflationary period, and real assets are where it's at. So it could be going on for years. What is your take on all of that with energy and
Yeah.
commodities and inflation?
Um, well, energy sort of, there you have several places that are working. I mean, crude has worked, natural gas hasn't. I'd like to see if natural gas moves above two, then you have a trade. But it's just been this, start stop, drop type of trade.
Mhm.
I think I bought gold miners about a month ago and wrote it up for like an 11% gain. I thought, okay, that's great. They've moved up a little bit more. And I like trading gold miners more than I like, for example, GLD. I think you get more
Mhm.
bang for your buck. But gold is overbought at these levels. I have Demark exhaustion signals that are starting to show up, and same with copper. I like copper, but it's getting a little overdone. Sentiment is a little high with those, but it'll be more interesting. And an old technician used to tell me, it's the first pullback that you see that really determines the next leg. And so when we see this type of pullback that's I think is coming, it will determine what we get in the next move. And certainly the Fed doesn't want commodities to keep running higher, and the government doesn't want that to happen. And so they run into that problem where they created a bubble in certain things and it's created excesses, and then inflation rears its ugly head again, and that's not necessarily uncommon. And there are actions that have happen when you have easy monetary and fiscal policies, and that's inflation. And inflation affects you and me and everybody watching this. And I I like to call myself sort of aggressively frugal. Um, my wife says that, she calls me cheap at times, but I'm kind of into being a little bit cautious as far as where I'm spending money. And I think people are more like me in the sense that they may eat out, but they're not necessarily ordering as much wine, and maybe they're splitting plates. That's happening because it's expensive. I mean, I'm taking my family out. I've 8 people I'm taking out tonight. Um, I will probably get nauseous when I get the bill, because and all my kids drink, and the husband and boyfriend will drink. I don't know what, but that's what the average consumer is starting to come to realize, and they've had this spending or this savings cushion, and if that starts to evaporate, we see more credit card spending. Well, we've already seen a lot of credit card spending. We have $1.1 trillion in credit card debt right now. That's a lot, right? I mean, what the government's doing is, spending like crazy, and it's creating the consumer to spend like crazy on credit as well. And, it just takes my breath away because I've been through these periods. And in 2007, we were the fund I worked for, a $5 billion hedge fund. We were short $1 billion worth of financials that worked out pretty well. I mean, we were early. I mean, 2008, early 2000s, actually late 2007, we started shorting Citi, Bank of America, Lehman, Bear Stearns, Goldman, all of them. We had CDX. We had everything. My friends that at the that did the Big Short. We had the same trade on. We were a little bigger than them, but the point is that that worked because we saw the excesses happening in housing. Now you have it with consumer credit, and buy now, pay later. Buy now, pay never. It's worse than the housing crisis because at least you could repossess a house or a car or something that they bought. You can't repossess somebody's Gucci bag or a flat screen TV. It's just a bad model. And if that starts to weaken and the consumer starts to, you start to see unemployment rise, it could spiral pretty quickly in the wrong way.
Well said. That buy now, pay later is very concerning. What can you repossess? I like that Gucci bag or, whatever, it's, yeah, there are a lot of issues you have to think about. And you made a good point about the small caps being sensitive to high rates. And that's true. I mean, they're very sensitive. So you have these leaders leading the market, these big cash generators, that don't rely on the debt and the cost of money being higher. But at some point, their customers will affect them as well. And those are the smaller caps. Yeah, very concerning. So I want to know some other contrarian views, contrarian opportunities that you're eyeing right now. Now you did great with energy, and you like the China, but what else are you looking at? Any cybersecurity maybe and technology?
Yeah, I just bought Palo Alto Networks, and
Mm.
that was one that surprised the market when they came out with earnings that were less than consensus. And that's what happens. I mean, when a company surprise, which is a well-loved company, surprises the market like they did, the stock went down more than it's ever gone down in a 1 week period. And it's just been, look, I think that there's certain things in technology that are not going to go away, and cybersecurity is one of them. And you hear about it every day, where these countries are, malware attacks and other things. And Palo Alto is sort of the standard bearer of of that sector. So if I can buy something like that that's down, um, I'm gonna give it a try. I'm gonna give it a try. And if spending in their next quarter continues to weaken, then I'll be wrong. But we've seen these pullbacks, and then people come in, they buy everything they can on pullbacks. But I think that that's sort of an area that I think that you always hear, Jamie Dimon will talk about the amount of money that they're spending on cyber, and that's Palo Alto. I mean, it might have been a little bit of a short-term issue too, because people, or actually data centers and companies, maybe allocated a little bit more towards AI, and I think they'll come back to spending more on cyber. I think that's I think we have an opportunity there. But other places, I'm not crazy about semiconductors. It's a cyclical business, and again, when the data centers get fully built out, and that will happen, those companies are going to slow. I don't like semiconductor capital equipment at these levels. I think they're overdone. I think they're overbuilding semiconductors right now. I actually, I, I see that the government is pouring all sorts of billions into semiconductor companies. They should be pouring money into utilities, quite frankly, because the utilities you're going to have to upgrade the utility companies because of all these data centers, because they use so much power. And again, going back to cyber, you could have Vladimir Putin, flip the light switch on the Northeast uh, grid and say, haha, look what I can do. And that would be fairly devastating. And I think that we're just not prepared there as far as the government goes. I think that's an area I think that the government should start spending more money on, as far as the utilities. I like utilities a little bit as well, but again, I'd like to get those at a little better price. But those they look okay. You get a great yield on most of them.
Wow, great points
Boring,
there.
right? It's kind
No,
of
they're
boring.
not boring. They're essential. I mean, what will we do without utilities? I mean, that's totally essential, just like cybersecurity. I think, when Palo Alto's CEO came out and said buyer fatigue, I was very concerned because I don't see that. I mean, having an e-commerce business myself, I mean, cybersecurity we've been attacked more than ever the past few years, and it's only going to rise with AI. So I think cybersecurity is a necessity. You can't cut back. That's something you can't cut back on. You can cut back on luxuries or additional bells and whistles and stuff, but not on cybersecurity. It's security. And utilities, another essential. There's some GE has been doing really well lately. There's CEG and the infrastructure plays. Any of those that you're particularly looking at? Are you looking at the ETF more for utilities? Or are you looking at anything particular?
I think you could buy the ETF for utilities. Not huge, but I think it's okay. I think that the companies they have some pricing power as well. So that they've been able to raise prices on the consumer. And the consumer really has no other option other than to pay to keep your lights on. So that's one area. I like pricing power type areas. And I think like one stock that I started shorting was Caterpillar recently.
Mhm.
That one's just run up way too much, and it's been sort of like GE, and GE sort of a spin-off we're going to spin off everything that Jack Welch put together and see what we come up with. And that's getting a little overdone as well. I'm not quite there on Boeing. I've had some people, and as far as industrials, I've had some people really say, oh, Boeing looks good. As long as there's headline risk hitting every single day with Boeing, I just don't have any, stomach for doing that. I'm just looking at I have all these screens over here. I'm short Tesla. I'm short Tesla, and,
I
and
think you were
I
short last year when we met too. You really
yeah,
called it with those lower deliveries and those estimates going down.
yeah, yeah, I mean, this is a company that is in decline right now.
Hmm.
And, the stock has this loyal following. And if you're long Tesla, I hope you own it a lot lower. Um, and if you do own it higher, I'd probably rethink that. Look, their delivery numbers missed even the most bearish estimates. And, Tesla's a delivery, story of, we got to sell more cars. We got to sell more cars. But they've been selling cars at lower prices, which are hitting margins, which the
Hmm.
margin story was the big positive for Tesla in the past. And now that margin story, they're back to where, the legacy auto companies are. China sales are tough. And you have BYD selling a $11,000 car. And it actually I watched a couple of videos on the car, and it's no frills. It's electric and gets people to where they need to go, and they're gonna sell a ton. Tesla's got this, there's always the hope of AI and full self-driving and all these other things, but that really has never come true. And the valuation for Tesla, it's a $550 billion company, and that's 11 times larger than General Motors and Ford. That's a lot. And it's still, if it went down, it got cut in half, which I think can happen, especially if deliveries continue to trend lower. I think that it's only, 5 times the value of General Motors, or the market cap of General Motors. It's much higher valuation. PE is still very, very high. So I think that's one that I can stay short. It runs against me with these annoying little bumps here and there, but my cost basis is, around 240, so I can weather a few of those. And sometimes when you get into a trade or a long, or position, and you're deep in the money, you can absorb some of the hits that go against you, and that's a luxury that maybe a lot of people in some of the AI stuff have right now, which is good. If you own Nvidia at $400, it's going to take a lot for you to turn around and sell it, because, oh no, I got such a big profit, I don't want to take a profit. Same thing with Tesla for me. I feel comfortable, especially knowing the fundamentals are starting to deteriorate notably. And Elon Musk gets a little desperate on Twitter as well, on X, I should say. So I wish I could play poker against him, because he's very transparent when he gets very desperate, when business is bad. So we'll see what
You
happens.
see right through his whole game, don't you?
Well, look,
Uh,
look, I think the Tesla cars, they're getting older in their lineup, and they have nothing new for the next couple of years. And they just said, well, it's speculated that they canceled their next generation smaller car, which would make less money for them, by the way. And it'd be difficult to compete with the BYD car. So they may cancel that, but they're going all in on robo-taxis. That's what they say. And, robo-taxis were a 2019 type story that jammed the stock higher. And it's not here yet. And first of all, I don't want to be in a robo-taxi, and I wouldn't want to put my Tesla, oh, let the car go do its robo-taxi thing and earn me money. I don't know who's in my car, and who's liable. Who's liable if it gets in an accident? Tesla? Me? Who? I just think that and are regulators going to approve it? And do people really want a robo taxi? I mean, I don't know. I mean, people could say, "Oh yeah, absolutely. I love the whole idea of a robo taxi," but I don't think it's as big of an opportunity as Kathy Wood suggests. I mean, she thinks it's an $8 to $10 trillion revenue opportunity. That's a trillion, not, billion. That's, you know, that's a little absurd. So and I'm short ARK, by the way, and
Oh,
partly because I'm short Tesla, and that's her largest position.
mm-hmm.
She's made a big bet on this, and her stock is still 75% or so off of its all-time high and can't seem to get going. So I'm happy to, stay short that as well. I think that again, I think Tesla's going to get cut in half.
I like that. You've been making some excellent calls. Last time we met a year ago, you were bearish on Tesla, and I believe you were shorting them back then, about, based on these deliveries. And EV sentiment has been changing. There's a lot of news. Hertz was reducing their EVs, and are they selling off their EVs? And I think there's a resurgence in ICE, internal combustible engines, and there's been a lot of that hype moved away from EVs. So, and that
Well,
fits in well.
one thing with Hertz, I rented a Model 3 when I went to Los Angeles. I think it was a year ago. And I asked the woman at the desk, I said, "So how are the rentals going with Tesla?" And she said, "Oh, it's a mess." And she doesn't know that I'm short stock.
Yeah.
But she said, I said, "Well, why is that?" She said, "Well, people don't know how to drive them." And I said, "Oh, okay." And she said, "We have so many come back banged up." She said, "I've never seen it with any other brand that they come back." And Tesla's notorious for not having parts to put these cars back together, and they're expensive to put back together. So that's sort of why Hertz is backpedaling on that. And so I think that, look, I think it's sort of saturated, and I think also higher rates makes it very difficult to buy a car. And you also had a lot of turnover with existing Tesla owners that would turn in their older car and get a new one. But the value, since they've lowered prices so much, the value of the older ones have dropped. So people are underwater on those, so they can't go out and say, "Oh, I'm going to, turn it in and buy a new car." That's sort of a problem that's slowing deliveries as well. So and again, it's an aging lineup. There's nothing new. Cybertruck, they're not selling.
Is that a
Good.
sexy truck to you? Is the Cybertruck sexy?
I always try to put myself in the position of what would you do if you were a bull? I would complain, say, and say, you should have come out with a truck that looked like a Tesla and not like that, and had it be something that is sort of familiar in the brand lineup, and have it look normal, and have it not necessarily stainless steel, which is expensive to produce and massive and big and all that. If you came out with something that was sort of normal, they probably would have sold a ton of them, and easy to produce. These aren't easy to produce, and there's a lot of complaints coming back that the suspension breaks, or it bricks where the electronics go black, and I just don't think that they've done their work as far as developing this. So again, they should have just come out with something that looked like a Tesla, sleek and cool colors, and they would have probably sold more. But I don't know. Elon, he does it his own way.
I guess so. Yeah, well said. I like that. And you are a car expert, so I would trust your,
I'm a car
um,
guy, yes.
you are a total car guy, and I love it. So, and I bet you would probably, I put money on you beating Elon in a poker game as well. You really call him out.
Well, he's got a little bit more money than I do, so he probably could he'd probably be pretty formidable. But then again, he's on when he gets desperate on X, and he has to refute every story when the stocks are going down. That's when you know that business is tough. And
Exactly.
listen, he's got a full plate, more than anybody running any company. He's got 5 companies, and it's it's hard to focus on one and
Exactly.
make it work. That's the problem.
Yeah, and he's got a lot of kids as well, so he's got
Oh
his
yeah.
hands full. So, sentiment. You are an expert also in market sentiment, and I love your market notes, and you discuss you do simple moving average of the 20 sentiment as well as price sentiment. So we've been talking about stocks. It seems to be a stock picker's market as it's been for a while. I want to go beyond the headlines and go under the hood and look at the internals and the sentiment that you're seeing right now.
Well, I use several market sentiment indicators, and one that I mean, a lot of people can get stuff free online. The I think one of the best is the CNN Fear and Greed.
Mm-hmm.
It's nice because there's 7 inputs in this, and it shows what traders are doing rather than what they're saying about the markets. I track the Investors Intelligence newsletter writer survey, and that's been sickly overly bullish, and they're sort of measured people, and they're saying it's in the danger zone. I look at for myself, and on our site we use the daily sentiment index data, and that is a daily sentiment index that it's sort of very similar to it tracks very similar to the CNN, but again, it's daily. The Investors Intelligence comes out every Wednesday, and it's a little laggy as well. But we've been in this range, and when it gets above 70%, that's when it gets elevated. That means there's 70% are bullish in the survey. It gets above 80, 85%. That's where you start to get a little concerned that it's getting frothy. All through 2024, it's been holding the 60% level, and just the
Hmm.
last week it's broken below that, but it's held the 50% level. And 50% is sort of the majority line that I like to say. And you can sort of look at that and think of it like an RSI. When you get below 50, you have more sellers that could weigh on the market, and the majority of people are now sellers or bearish in the market. And in 2020, market sentiment in March, the end of March, got to 4% bulls. I have actually the CNN Fear and Greed. I screenshotted it somewhere where it was like 0. There was no, so it was so overdone. And I got bullish when I get to these extreme levels. And I said, it can't get much worse than this. And so I started buying and covered shorts. And I had people, my subscribers would call me and say, "Are you feeling okay? I mean, did you get COVID?" But in 2022, we had those pullbacks, and they gave us, oversold conditions to like 10, 20% bulls. And then we lifted back to 50 and sold. And it was sort of a good scenario for trading. Now it's just been this like steady place up there, but we're starting to see it come in a little. And internals, we're starting to see some negative divergences with advanced decline data, the put call ratio that I like to look at, equity only put call ratio. I run a 5-day moving average of the equity put call ratio. And usually when people go out and they're buying puts aggressively, that spikes. And that's like, calling your insurance company saying, or calling an insurance company and say, "I'd like to buy insurance, my house is on fire." And so when that happens, when you get this spike in the put call, then you basically can go the other way and buy stocks, because people are overly shorting by buying puts. So you can get a bounce there. So we're not there yet, but we're starting to see a little bit of weakness. And simple 20-day moving average has been the holding pattern for the S&P and NASDAQ 100 for since November. And we're starting to break that. And the 50-day, we're starting to come into play as well. And as much as those are just numbers, I think it's good because it gives a trend of where things are. And if you start to, if you have a market that starts to just go sideways, and March was a very choppy month, and not necessarily a great month, and April's more of the same, just sort of soft. if we start to break those levels, those people that bought higher, and a lot of people bought, we've made lower highs from the Fed meeting as well. We had a spike with the Fed and Powell's dovish and yah. Those people, when they get caught in those, they bought up there, and if prices start to come down, they're going to become motivated sellers. Nothing motivates someone to sell when they start to see red on their screen and it's not working and it's time to just get out of this. And, I'm guilty as ever to say, it's not working, so get out of it and move on. And that's kind of what happens when you start to get these processes of a top. So we'll see. And the Russell's not acting so great lately. The Dow's not acting so great lately. It's just one little accident or a banana peel away from slipping, and we have a fairly sizable pullback, and that would be great because we want to buy. We want to have some ideas, some places to buy, and that's been elusive for those of us that like to buy real dips.
Absolutely. These pullbacks that we really haven't had are healthy. And I always say they help fuel the market to go higher. But yeah, we haven't had that. I know that the Dow, I think, is hanging around the 50, between the 50 and the 200. It's pretty low down there. And I remember reading your notes, I think, about the NASDAQ maybe exhibiting a topping pattern. And you were using the Demark sequential countdown, and then you said that maybe it could be starting. Could you tell us about your process with that and how you
Yeah.
use the Demark?
Um, so it's sort of a longer topic, but the Demark indicators are used, and they were developed by Tom Demark in the 70s, pre-computer. He created these on paper, and had reams of paper in his garage and tested them, and he's sort of like a beautiful mind type of character. But what happened is, computers came around and he could test these indicators, and Larry Williams was also instrumental in creating these indicators with Tom. And they count this, there's countdowns that get to, let's say, 13. That's sort of the magic number. And then that's kind of telling you that the trend is sort of exhausted. And it doesn't necessarily need to you know, the next day it crashes, but it could be just exhausting the sideway, and it can move sideways for a period of time. And essentially the last buyer is bought when you get that type of signal. And if it continues, the signal is invalid. And around 65% of the time those signals work. And when they work in a rather spectacular way. So I like to see a lot of signals happen together rather than just random one-time, one-off. And we've seen a lot of weekly signals, daily and weekly signals on the upside. So it's telling me that the market's getting a little tired on the upside. And again, the problem is, I'm looking right now, breadth in the market right now. The NYSE has 189 issues up today. The NASDAQ has 318 issues up today. The market is up, the Mag 7 is up 2.4%. Yesterday's breadth was down 3,000 issues on the NYSE. So 200 issues up today is sort of a terrible number considering the indices are up as much as they are. So it's very narrow. So I look at all the, I grind all this in my head, and, it's people will say, well, I'm long SPY and Qs and I don't care. Well, yeah, that's great. But the majority of stocks are not going up. That's the problem right now. You're seeing more stumble and run into slowdown, but you have the Mag 7 is up, and that's been driving the gains in the market. And as long as those work, the indices will probably keep going. So look, I think that we have the ability to start a downside sequential countdown. And I thought we were getting that earlier today, but lo and behold, the little cooler PPI number came out and lifted the markets higher, and a little better 30-year auction lifted things higher. Rates are still high, they're still up, but it doesn't matter. Buy the Mag 7 and you're all good. And that's what's been moving this market. And one by one, like, Apple's up a lot today, Tesla's up, which Nvidia's up almost 4%.
Mm.
Um, one by one, those will start to tail off. And you've already seen it with Tesla and Apple, and you'll see that happen with others in this group. But for now, again, the music's still playing, so keep dancing. And I get a little um, overly analytical, and I look at breadth and I think, well, not everything is working, so it's not necessarily, spectacular today. Russell, Russell's up, I think. The Russell's very correlated with heavily shorted names as well. So the most shorted, the Goldman Sachs most shorted basket, it's only up like 0.5%, which is not much on a day like today. And the Russell is up 70 basis points. So it's not like it's just, it's sort of, they're sort of correlated together. But again, I don't think a lot of shorts are in this market right now. I think people are very long, and nothing's going to shake them out until we start breaking some levels. And until that, all my words are sort of like, oh yeah, great, whatever, we'll see.
Well, you're ahead of the time because it just seems to be a matter of time. So maybe you're just a little early, but once they hit those.
Early is another way of saying wrong.
No, not at all. You were early with energy and you did fantastic. And, I think that, like you said, great points, that once you start hitting those support levels and the people who bought really high, when they start seeing a deep red in their account, that can cause a cascading effect. And that's how we can drop really fast, quickly.
Yeah,
So,
and
definitely.
that's, I'm also looking at like the 1 month performance, and we're starting to see some sectors lose the love. Like biotech doesn't look great. Even like the Bitcoin is down in the last rolling 1 month. You have RSP, the equal weight, the diamonds, the Dow. Ethereum is down 12%, in the last month. Nobody cares. Nobody
Are you
cares.
bullish Bitcoin?
No, no, not at all. I'm not, I don't, I'm not a crypto proponent or antagonist. There are currently Demark sell countdown 13s on daily and weekly timeframes, and usually when those sync together, that's more of a concern that we're getting a little overdone here. But Bitcoin bullish sentiment has been dropping while the price has stayed relatively elevated. Um, that's like I don't know how I don't people that have made boatloads of money in Bitcoin, God bless them. Don't forget to ring the register because it has that feature of dropping 50% every couple of years, and that's, as some people have said, that's a feature. Um, but look, it's a little overdone. I don't know how to value it. There's no usage for it, and it's just the next person buys it, goes higher, and that's what you wish for if you're buying it. And the DeMark indicators, I've had a very good call using those. Probably should trade it because back in, it was 15,000, and actually November of 2021, you had 13s on the daily and weekly, and it dropped to 15,000. You had buy countdowns at 15,000. That was when FTX was blowing up and everything was, like, oh, you can't. I said, well, maybe, and it's moved up, and it's now you have the ETFs. I'm short a little of the ETF, not much, but I trade that around a little. So that also has a 13 on it, so that's what I'm watching there. So we'll
That
see. I
matches.
look again, they're crowded. I don't think you have a lot of people that are short Bitcoin. Ethereum's been sort of weaker than Bitcoin. You I kind of just watch it, and I watch the price action, and again, I don't have any bias, and those that are religious about it, with any type of asset, I sort of avoid because they don't really have a clear bias other than I love it. That's what I worry about with some people. But again, there's a lot of people that have made money. God bless them. I hope, viewers that are watching remember diversify. You don't want to put all your eggs in one basket and or in one thing. And there's also crypto sort of a good sentiment rate as well. When you see people that are making just gobs of money and coins that don't have any value, and Dogecoin or some of these others, the misnamed or misspelled, Joe Biden, you're like, it's $5 billion in that, and people are making like gobs of money, and God bless them if that's the risk you want to take. I just can say I'll pass. That's not for me. It's like someone saying, "Hey, you should be buying bonds," and I'm not a bond investor. Well, okay, what are you going to do? I'm not a crypto investor, but I track it and I watch it and I can analyze it. It's just I know that if I bought it, I would be the last buyer. That's just always my fear.
You are so funny, I have to say. Yeah, there's something for everyone, and it's not my cup of tea either. And there's this one Pepe, I think it was like frog or something, and it went
Yeah,
up
I
like
mean,
crazy. Yeah.
NFTs, like I, I I I wish I had the money to blow on some of this stuff like people have. And that again, that's sort of a sentiment read of as far as the liquidity that people
Liquidity out
have,
there. Hmm.
that people can just blow money on crypto and speculate, and they're on their phones. And it's I was in an airport and I saw this airport worker, and he was trading, crypto. I said, "Which one are you trading?" And it was like the Joe Biden one. He's like, I'm buying this one." I was like, and that's kind of like, that's not what you want to see, because that's what happens at tops. You have this crazy, I got to buy JDS Unifies, I got to buy Cisco, I got to buy Nvidia, I've got to buy all these things that have already worked, and you get trapped in them. And that's the risk that could certainly happen.
Absolutely, well said. There's obviously lots of liquidity out there still, even though the Fed keeps saying that, they have QT going on. We know that there's so much liquidity that's mitigated the effects of QT, and these rates aren't really affecting as much as we want. And I don't think the Fed has the right tools to lower inflation. It's like a runaway inflation that we have. I want to ask you about inflation, but I got to get it. We want to talk about bonds before we get back to some Fed stuff. Um, First, S&P 500, we're looking at about the same level we were beginning of March. So we sort of gone sideways. We ended up where we started, it seems, a month and a half later. It's been like a choppy sideways back and forth here. What about the bond sentiment? It seems to be at a low. It's coming down significantly. It's
Yeah.
had a bad beginning of the year. What's going on over there? And the yields are up. They've been increasing since December.
Yeah, I think yields started, so one of the things that happened back in late October and early November, is that the stock market positioning with the big CTAs, the trend following accounts, were all short bonds and expecting higher rates, and they were short stocks, expecting stocks to go lower. And then Janet Yellen came out and said, "Oh, we're just going to buy T-bills and shorter term duration debt." And that schedule sent everybody into a tizzy, and they had to move their positioning. And they basically bought bonds, which is what she wanted people to do,
Mm-hmm.
because lower rates are good for the fiscal responsibility
Mm-hmm.
that they should have. And it helped the banks move higher. It helped stocks, and that was really, the start of this move. But in February, the bond market, that long positioning that occurred, started to reverse. And that's where I was like, I was miffed, because I thought that you'd have that also with the equity markets. You'd have that positioning start to shift, and it hasn't yet. If it does, probably like 5,100, 5,000, if that starts to break, then you're going to see those trend following funds start to reverse their long positions. But rates keep going higher, and I think the bond market is sort of the market of truth right now. They're the ones that are trying to keep the Treasury and the Fed, um, telling the truth of as far as inflation and what's going on in the economy. It's strong. It's real strong, and it's going to be stronger, is what the bond market's telling you, and that's why it's selling off. And here we are, We're at 493. We're down 4 basis points on the 2 year. The 10 years at 456. It's up 2 basis points. It doesn't seem like it's, that big of a deal. But if we get another few reports that are a little bit less Fed friendly, let's say the next month CPI comes in and it's also relatively hot, then you're probably going to see rates continue to move higher. And you have all this issuance. The Treasury has to issue tons of debt. Yesterday's 10-year auction was weak. Today's 30-year auction was strong. It's always, it's sort of a hit or miss. But if we have to keep selling debt and it's at a higher level, that will be a problem for our children and grandchildren. And it, again, the national debt is going up $1 trillion every 100 days. So, come this summer, it's going to be up another $1 trillion, a trillion. And it was like, back in the 2000s or 95, some people say it's like 95, AI.com, the internet. No, that was actually, we had, I think, 3 trillion in the national debt. And now we're going up 3 trillion per year. And the debt service on that is, I think, just slicing into our productivity and our growth in our country. And I don't know what's going to change it. I don't think there's a politician that's willing to jump in front of that. Because hey, keep spending, you get this, we'll keep, we're not going to cut anything because we need your vote. Again, I dislike politics immensely. I'm center, I sort of rational thinking, but I don't think there's anything we can do or any politician that's going to be able to get us out of this problem without some sort of hairy problem. And, it's like the Fed and the Treasury and the government, they're like it's like treating a heroin addiction by giving them methadone. Oh, well, that's what they used to give heroin addicts, oh, we'll give them methadone, which is, meth. And it's like they're giving, like, how do we fix debt? Let's just add more debt. And now the problem is debt, the rates are higher. So if we add more debt, it's at a higher rate, and it's like a stronger drug that we're taking, that eventually something bad's going to happen. Oh, we can just print our way out of it. Yeah, well, maybe we can, but the dollar still stays strong, and inflation's still high. I mean, I just think that we're sort of in this vortex of like kicking the can down the road, spinning around all this extra debt and all this extra capital that we need to service our country's debt. I mean, look, if we go into a recession, and this has been a lot of people, including myself, thought we'd be in a recession. We're not, happily, I will say that. We may next year. But if we do, the deficit is at $2 trillion, and that would be the highest deficit ever to enter a recession. And what are they going to do? They're going to borrow more money. Let's just throw money at it, because we're politicians and we'll be dead by the time it has to get paid back, or it never gets paid back. And that's the problem that I see. That's a longer term, and I probably should be having cocktails over this, because it's like people are probably now watching this going, man, I need a drink after this. But it's true. We have to just be cognizant of that. And other people say, well, I'll just buy NVIDIA.
Just
Forget it. I'll buy the Qs and I'll forget it. It's no big deal. And that's the problems that I see, percolating out there. And next year, we're going to have a new president. It's probably going to be a very old president. It's going to be a president that's going to do the same things that the previous one did, and the previous one before that is just keep spending. And I don't have any faith that they're going to do the right thing or they have the idea of what they can do. They can't cut spending. What are they going to cut spending on? The debt that we already are paying? I mean, that's the problem. Now it's like, if you cut spending on Social Security, that's one thing. If you cut spending on military, that's one thing. If you cut spending on healthcare, that's one thing. But the problem is that the debt service is becoming so big and you can't cut that because you've created that. And that's a default if that happens. And I don't necessarily see the US defaulting, but it could happen in another country. It could happen in Japan. They have a massive amount of debt. It could happen in Italy. They have a massive amount of debt if things start to slow down. But the US is just in this crazy fiscal spend. And so what? Who cares? That's what people are saying. Who cares? You know what? They're just going to keep spending. And that's what the consumer's done. The federal government is doing a buy now, pay later strategy with the government's finances. And, Janet Yellen is selling short-term 3-month bills to fund the government. I mean, that's just nuts. Oh, and why didn't they just, then you have these, second guessers that say, well, why didn't they just sell tons of debt when interest rates were so much lower? Well, who would be holding that debt today at those low rates would be holding a debt instrument at a massive loss. And that's what happened with the banks and
Mhm.
Silicon Valley Bank and all these other banks that don't need to mark their long-term debts to market anymore because the Fed and the Treasury said it's okay, we'll just take your word for it and don't do that. But the 10 years at 456 and 456, the 30s at 466, and people were freaking out when the rates moved over 4% and banks were blowing up. But now the government says it's okay. You don't have to report that mark to market stuff. That's just, we trust you. It's okay. Really? I mean, there are capital holes in some of these financials, but the stock market goes up, everything is sort of okay. Oh God, I didn't really anticipate me getting all worked up over
I
this.
love it. I have to say, I've had many economists on this show, and we talk about the same exact thing that you just said. So our audience is
I don't
taking
drink
notice.
either, so I don't drink, but I feel like I need a drink. I feel like I need to just go out and do shots of tequila and say, God, stop.
Right?
So I feel like I'm the guy on Network, that old movie where the guy's like, I'm mad as hell, and like, no, I'm not that crazy. So I'm actually a very rational,
You are
calm.
very rational, and what you just said all was very rational. I mean, the Fed's injected liquidity with the BTFP, keep more banks from collapsing. I mean, with the unrealized losses, and you said a great point. We haven't even entered a recession, and we all thought the recession would have been here by now. But of course, it's an election year, and they keep kicking the can down the road. And maybe the recession that's supposedly baked in by many economists will come next year. But that's when they spend more. Usually in a recession, you spend more. But it seems like they're spending now, and they can't stop, like you said. And the interest expense is over $1 trillion per year. And how they gonna be able to pay that off except to print more? And the debt is insolvent. And that many economists have said that word. The debt is insolvent. And
Well,
it's
I didn't go that far. I didn't go that far, but
okay. And I'm
I mean,
just going.
I'd rather own U.S. debt than a lot of other countries' debt to be, quite,
Absolutely.
and you know what, we might even be at a place right here where it could be a trade because if all of a sudden you start to see rates drop, it could be a risk off type of thing where the equity market's selling off. And in the old days, if you had bonds rallying, it was a risk off environment where people were putting their safe money into bonds and selling stocks. So we could see that
Good, yeah.
happening. So like I'm always aware at these levels on rates that there could be a long trade setting up.
Absolutely.
So I'm more than happy to change my opinion when things change.
Absolutely look for those opportunities because absolutely, like you said, there could be that opportunity there, for sure. So do you think we're in for a secular inflationary period and that maybe 3 to 4% may be the new 2%?
Again, I think that the problem is the longer we have inflation staying sticky, let's say above 3%, maybe if it gets to 4%. There's the super core, which excludes a bunch of different things.
some people have been saying it could go to 8%. It weighs on the consumer. It weighs on companies. It weighs on consumer spending, savings, and then things get a lot rougher for people, and it gets tougher on the government because they have to support these people. And I think it's completely ludicrous when the Fed's saying, well, we might want to slow the taper of our bond, the QT of tightening. We may slow the taper. We may not sell as many bonds. They need to lower their balance sheet. They've taken it down, and kudos to them, but it's not necessarily at a level where I could say they have the ability to just say, oh man, we have a problem, a real problem, and we need to do QE, and let's reflate. I mean, it's still high. You're not gonna you're not gonna get really the Fed should have their balance sheet closer to levels where it was pre-COVID. Still 4 trillion higher, I think.
Mhm.
That's a big balance sheet, letting it run off. And I thought that, if they really want to, put some hurt into the economy and slow inflation, increase your QT, raise rates again. I mean, I don't think they're going to do that, but that would certainly, if you want to slow inflation, there you go. That will do it if you really press. But again, it's an election year. I saw a video. I don't know how credible it is, but they were saying that some Fed official was on hidden camera, and they were saying that the Powell doesn't like Trump. And look, I get it. Look, but he's not very nice to Powell. He said some very nasty things to Powell, and so maybe that there's some political bias with the Treasury. I think easily with the Treasury, that's there that Janet has her hand on the joystick, and she can do whatever she wants with the Treasury balance sheet. But look, I think that I think the political aspect of all this is going to get a little heavier too. I mean, they could hand over the keys to Trump if he wins, and again, I don't like either candidate. I would vote for someone younger with a little more rationality. A plan would be nice, but then I'm asking a lot there. But I'm sort of a center guy and don't care about certain issues, but I care about some others. Um, but the bottom line is they can hand over the keys to Trump, and there's no gas in the tank in the Treasury, and all of a sudden the world explodes and Trump's scrambling to do something. And I don't think I've never heard a plan that he has that's going to solve some of the problems that we have. He more talks about what other people are doing. And then again, Biden, I think he just sort of is kicking the can down the road, and the economy's great. Inflation's come down a lot. It's still going up, Joe. Okay. It's still costing us a lot of money to do and buy things. That's the problem. So I just think politicians are awful. I mean, look, one thing I've said, and I know I'm kind of rambling here, is that the U.S. has been in a long projected bear market for competent political leadership. And that's, I think, something that is troubling long term. But I don't know who's going to step up? Who wants to step up that actually has a pretty good plan? We like crazy in the US. We like the polarization. Somehow, that's what we elect. And it's troubling for someone like me that wants someone that perhaps is younger, perhaps has a different voice that will speak more towards what more people want and what we need. Actually, well, not what we want, but what we need longer term. I mean, look, China does something that, and I'm not defending China's government, but they have a longer term approach to a lot of different things. We have a election cycle approach every 2 years of what we need. Creating an infrastructure plan, help the utility companies build, semiconductor companies, build, put people to work in the US. There's a lot of that happening, but we need to do more of that. And I just don't think the US is really thinking the longer term, especially in the fiscal responsibility segment. You know, I think, again, going into the election, you have so many different things happening with both candidates who I think are flawed, and I think people would be like, oh my God, I'll vote for him or her, or who cares what party it is, because they sound a little bit more rational. I think people would jump on that, but we're not going to get that this year. We got who we got. And it's just, again, I don't drink. I feel like I should after just discussing this.
Well, Tom for president. How about that one? You seem
No,
to be
no. I
sober.
mean, look, and the problem is that we need someone that's going to come in and be like, okay, we're taking away the credit card from you, you
Mhm.
crazy teenager or 21-year-old daughter. I speak from experience in that you can't spend like this anymore, and we have to fix things that are broken. And you can't fix things broken that by doing the same thing over and over. I mean, that's the problem that we have.
Well
So
said.
we should just buy Nvidia. God, just
Right, just buying video. I know, right?
buy Nvidia. It's up 4%, and it's up 4% every day. It's up 37.
SMCI's pulled back nicely, right? It's like
Yeah.
they're fiscally irresponsible. And when you said there's going to be a new president this year, it's actually it's either going to be the previous one or this one. So it's like there's
And
nothing
we know
new
what
at
we're
all.
getting. We
Right? At
know what
least we
we're
know what
getting.
we're getting, right? Look at the
I
positive
mean,
side.
and look, I have people that like I've had some people, that are like serious Trump people that oh, you gotta be in. Like, no. And then the Biden, oh, you can't have, you gotta have Biden. I'm like, no, I make my own decision, and I'm just disgusted by the lack of variety. And we just had our Connecticut. I live in Connecticut. We just had our primary. Nobody voted because you already know it's done. What's the point? We already know who's in. Where's my voice? Where's my vote? It's already
Right?
done.
Where's the
So it's
democracy?
just I know it's like I'm really like, Tom, you're bumming me out hard today. I'm
No,
sorry,
you're a
but
reality check. It's good. It's good for everyone to hear this. It's very
yeah,
important.
people
You're
can
very
call me and they can
pensive.
say, just chill out, have a beer, relax. It's okay. Go out and
You
buy a
made
bit.
you made another great point. And now Biden's saying rate cuts. I mean, you hear a president saying rate cuts now, and the Fed's already lost credibility, and not only with their transitory talk, but they seem to be very becoming a little political now. And so you
Well,
have
listen, I kind of get it, and I kind of get why Powell. Listen, it's a lot easier to be dovish than hawkish. People like doves. People like easy money, and they like stock markets going up. And if the stock market goes up, that will create more tax revenue eventually for the Treasury, and that is good for the country. Maybe it's a cheap way, a relatively cheap way for keeping our GDP very strong and keeping tax receipts coming in by them throwing all this liquidity into the markets. I mean, yeah, there's one way of looking at it, but sometimes it's free markets that you have to sort of think, well, when does free markets, come into play? And sometimes the longer you prevent dislocations on the downside, the harder they fall. And that happened in a lot of different periods. I mean, you have one thing that we didn't talk about is the volatility selling funds. There's
yes,
so many
the
funds
vol
now that
selling.
just, yeah, they just sell vol. And it's like the amount of assets that are in these funds that sell puts and sell calls is massive. It's so much bigger than the Volmageddon period. And if all of a sudden that period, or we have some sort of dislocation, those funds that sold puts are going to get exercised, and it's going to be ugly. It works great when everything is sort of up, working nicely up and easy. But if things get volatile, those funds will have to, have some liquidations and take losses. And they're all levered. I mean, everybody's levered, right? Isn't everybody has to be levered
Of
and sell
course.
vol, levered,
Fiat is dead.
lever it up. levered up. What could happen? You know, it's just money.
A
You know,
lot can happen.
I always tell people it's just money.
It's just money, right?
It's just money.
The ball selling firms, that's a huge, huge thing. And they've been doing it for a while. And of course, it just caught news. We've been talking about more recently. I had Jem Carson. I don't know if you know him. He's on.
Yeah, I know.
Yeah,
Yeah,
he's great. And he was
nice guy.
talking. Yeah, he was talking. He's brilliant at all the options flow and everything. And he was telling us all about that. And it's just insane what's going on. So I have to ask you, Tom, what, in your opinion, what is the straw that's going to break the camel's back? You're so experienced and you're so pensive. What do you think could be? Is it the vol selling? I mean, what do you think can do that to this market? It seems to be it could very, it could be very fragile.
Well, one of the things that could happen, I mean, there's a couple things. And sometimes it's one thing that leads to other things
Mhm.
that cascades. And the vol selling strategies could have a nasty day. You have the zero dated option crew that keep buying calls and puts, and that's how the cool kids are doing these days. Those could blow up. You could have just some sort of problem in that regard that it causes the CTAs to have to sell. And we haven't had one of those days where it's just like, holy crap, what just happened? Oh, there's a terrorist event, or there's some big company, Nvidia, missed their numbers and it went down 20%. And down 20% for Nvidia is $400 billion, or a little bit more than that. That would be sort of felt. That's something that could happen with these mega market cap names. You could have Tesla go down significantly and cause everybody to freak out. You could have some outside thing. I mean, look, we have all these, we have wars in the world. That's always a terrible concern of people. You could have some sort of dislocation in the Mideast. You could have a nuclear bomb go off somewhere, some rogue state, Putin. Ukraine could get, something really bad. But I just don't think the market's set up for that. And that's the problem. You have the CTAs, max long, breaks 5,000. They turn seller twice, because then they start shorting. They go into the other side of it. And that could exacerbate things. In 1987, it was this portfolio insurance, which is not in computer program trading. And I was actually an intern at a brokerage firm back then, which way back when, it tells you how old I am. Actually, I was very young then, so I'm still young. But this program selling could be very similar to the CTAs or the vol selling firms getting liquidated. I mean, Volmageddon was, we had a 10% drop within like 4 days in that February of 18, I think, 17 or 18. And yeah, that was rather hairy, but it was fairly contained. Now it's like 50 times bigger. So look, God, again, you're asking me all these different things, like what ifs that could happen. It could just be where the buyers just start, trimming. They start trimming and people start selling. The CTAs start to wobble a little bit. You could have rates spike. Usually it's rates spiking is always one of my things that causes equity markets to sell off, but this is it hasn't happened. I mean, if we have a day where, the 10-year moves to 5%, you have a 50 basis point move, which it could happen. You have the 2-year breakout to like 5.5% or something dramatic. And you have this bond liquidation. The bond market's really big. And if you get people off sides and they're, if you hit new highs on yields, that means people are holding things at losses that bought in the last 10 plus years. So that's,
There's so much.
new lows beget new lows, as someone has once told me. And if that happens in the bond market, Again, there's a lot of leverage in the bond market, and that could cause, cascading effects. So you're asking me like the worst case scenario type of events, and certainly that is one that where things sort of add up and start happening all together. It's not necessarily one thing, and terrorism could be one thing that would do that, obviously, and hopefully that doesn't happen. A war escalating, the markets have sort of ignored the Ukraine war and what's happening in Israel and Gaza, and but if there's some sort of escalation there, yeah, that's a lot of people will hit the sell button together. So
Absolutely, with that
you know,
long
I'm
end, yeah, blowing out, the long end definitely will affect the bond
but
market.
they'll hit the sell button on the equity market, and they'll buy bonds if that happens. I'll buy bonds if that happens. If there's some sort of geopolitical event, you buy bonds.
Mm-hmm.
Done. It's like you don't get pricey. You just buy what you can, and you should be okay. People aren't going to sell bonds, and if there's something like that, I don't think.
Got it.
And again,
Thank
yeah.
you so much for that. It's important that people stay aware of all these potential things to focus on, to just know what to watch for. But thank you for giving us all those unfortunate scenarios.
Yeah,
But
you know what? My wife would not listen to me if I started to talk like that. Like I don't talk to any, sometimes I don't, who am I going to tell this to? I tell my subscribers, like this is the what if type thing, but we
Mhm.
really sort of covered it here.
Mhm.
I don't tell my
Great.
wife anything,
No.
as far as the markets go. I don't talk
Absolutely.
politics. She needs to be segregated from some of the conversations and worries that I see happening.
Mhm. Absolutely. Well, thank you so much for sharing with us. Everything means so, and it's important to just be aware of all these things. I want to end on a positive note. What are your
Okay.
top 3 favorite cars that you're looking at? What do you like these days?
Well, I don't have, well, I just sold my BMW M2.
Oh, we talked about that
Yeah.
last time.
Yeah.
Oh,
I
you
love
sold
that
it.
car. I sold it, and sort of a little pressure from the wife because it was a little aggressive. But what I'm building some marital capital with that. I bought her a new
Mhm.
car.
Nice. Range Rover. I remember she had a Range Rover last time, I
Yeah,
think, right?
yeah, I took her older Range Rover. It's a 2011, people. Yes, it has electrical problems. Yes, it's fun, but it's V8 and it's a
Love
workhorse, and
it.
I like it. But she has a newer one. But anyway, um, that's what she drives. She's a very particular one. But I really want to get a Porsche GT3 RS. No,
Ooh,
not RS, the GT3
DG3
Touring Edition.
touring.
It doesn't
Yes.
have the big wing on the back, and it's a little wider, but it's fantastic. And I was able to get a ride in one a couple weeks ago, and it was just so much fun. But fun's got to get a little bit higher, people, and gotta make a little money in the market. Hopefully, we get a little bit of a downside move, and yeah, maybe that will be down the road. But again, I built up some marital capital, so that's good. I
Delayed
do like the
gratification.
I like the Range Rover Sport, the new one. I
Mm.
like that one too, but I don't see myself buying that. All-time dream cars. I've been kind of, I played lotto. Okay, I mean asymmetric outcome, why not? $20. But I would have bought the Ferrari F40 and the Porsche 959 from the 80s, early
I like
90s.
that.
Brilliant cars. The pinnacle of the air-cooled Porsches, and the last Ferrari that Enzo Ferrari blessed
Mm.
and saw. And they're basically race cars, but those are my, I'm a purist in that sense of cars. So I'm not buying an electric vehicle. I'm not, I just like the sound of cars. I love mechanics of them. That's just sort of my thing. I build model cars. I have like, here's my,
Right. I love the way the
I
Ferrari
have the Range
purrs.
Rover here.
Oh, nice. Doesn't that the
Um,
sound of that Ferrari, beautiful sound. The Maserati
yeah.
has a nice sound to it too.
Yeah, Maseratis. I was looking at one on Bring a Trailer, which if you don't follow Bring a Trailer, you should, because it's an online listing service for cars, all types, good cars, bad cars, and they send you a daily email, but Maseratis are a great bargain. You know, it's basically a Ferrari. But like I saw one and it was like $50,000 used. And it was a, you know, two-door nice. And, you know, that's like I mean, I bought my daughter an Audi and that's what I paid for that. I should have bought her a Maserati.
Yeah, right?
No, she'd be looking at me like, Dad, come on, I can't drive that. That's too much. But Maseratis are fantastic. I like Italian cars a lot.
Thank you so
Okay.
much, Tom, for everything. This has been
Thank you.
fantastic.
Thanks
Very
for everybody
enlightening.
that watched and spent this hour and a half of fun chatting. And it's always fun just to kind of get stuff out. It's good. I feel like a
Absolutely.
therapist.
And then
Like
you've been bearish, so you got to take out all your bearishness on here. We got to hear it all.
It's not that bad. I have
It's not
some
bad
moments.
at all, but you're cleared out. Now you can have fun at your dinner party tonight.
Okay. I'll talk to you.
Thank you.
Have a
Take
good
care.
one.
Bye-bye.
See ya. Bye.